Good evening, everybody, and welcome to the Equity Market Insight for November 2023. Ever so quickly, we have pretty much reached the end of the year 2023. Time has moved quite fast. And we are going to stick to the script in terms of the agenda for today's Equity Market Insight. As usual, I'll start off with covering a little bit of the macro and earnings and market current happenings picture. And then, of course, joining me on the call today, we have Srivatsa, fund manager at UTI for nearly 20 years. And he's going to be talking about the strategy that he manages, which is our, more traditional value-oriented, large and mid-cap oriented strategy. So he's going to be talking about that. And of course, we've already received quite a few questions from you. And I'm hoping that during the course of this conversation, more of your questions will come in. And as always, we have the redoubtable Niranjan on the call today from the product team, hosting it today from Bangalore, where he's currently traveling. And he'll, pull up the presentation on the screen and also guide us through the Q&A section. Before we get underway, I should also say thank you to all of you joining us here today on the call, because I was honestly quite worried as to how many people would join the webinar live, given that it's also the India-New Zealand semi-final happening, in fact, in Mumbai, quite far from where I'm seated. But yes, the semi-final is on, and I'm told the score is now 194-1. So India is off to a great start. And just to be clear, we are discussing cricket, not the markets. But we'll try and keep you updated on where the semi-final is headed during the duration of this webinar. But we'll be done in an hour, so then you can get back to watching the match. And remember, you can always come back to YouTube, where we eventually host the webinar permanently, so that any of you who missed it live, or if there are patches that you want to catch up with again, you can do that on the YouTube channel of UTI. So without any further ado, we'll just dive into the presentation for today's Equity Market Insight. So what are we going to be talking about today? The first slide has got the balance sheet of the US Federal Reserve. Now, what you can see here is how there is a continuous rise in the size of the US Federal Reserve balance sheet. In fact, it was unchanged for almost more than a decade. And then when the global financial crisis hits in 2008, and then in 2009, the Fed embarks on quantitative easing, and the balance sheet continues to expand through multiple rounds of quantitative easing, all the way up to almost 2015-16, where it starts to flatline. Sometime in 2018, the Fed tries to start reining in the size of the balance sheet, though it isn't very successful. Then, of course, the pandemic hits in 2020, and the Fed repeats what it did in the previous crisis, like in 2008, 2009. It opens the floodgates of liquidity once again by pumping money out there and acquiring assets, treasury securities, agency debt, mortgage-backed securities. And also this time around, they opened themselves to purchase of other assets quite significantly. And so you see the size of their balance sheets, which had reached about $4 trillion, double in a very brief period. By 2022, it surged to about $8 trillion. In fact, it's almost nearing the $9 trillion mark in terms of the size of their assets. In May 22, the Fed embarks on a tightening cycle. It also embarks on the reverse of quantitative easing, which is quantitative tightening, which means it is now starting to sell down bonds on a monthly basis into the market, and it's starting to reduce the size of its balance sheet. But it is doing this at a pace which is much slower than the pace at which it expanded its balance sheet during the pandemic. So in all, we have reduced the balance sheet by just about $1 trillion since the tightening actually started more than a year ago. So we are in a period of the Federal Reserve starting to reduce its balance sheet. Now, this is interesting because the US is now faced with two conflicting parameters that it has to deal with. One, issuance by the US government is going up because the fiscal deficit of the US has now almost gotten stuck at about 7 to 8% of GDP. So issuance by the federal government is going up, and simultaneously supply of securities is going up even faster because the Fed, instead of being a buyer of securities, is now actually selling securities. The net result of that is what you see on the next slide, which is that we see the US 10-year bond yield come up to almost the 5% mark, though it has cooled off quite a bit in recent days. But again, at that 5% mark, it is now at levels which were last seen only during the global financial crisis or pre-global financial crisis, which was in 2007, which was the last time that we saw the 10-year bond yield close to 5%. So in a way, this is a very different era as compared to the previous decade. If you look at the period from 2011 all the way till when the pandemic hit in 2020, the average 10-year bond yield was closer to about 2%, and it went as low as 0.5% at the peak pandemic. But the average was also below 2% during this entire period. So for almost a decade, we had a 2% rate average. We had almost $18 trillion worth of bonds, not US bonds, but European bonds predominantly, which were trading in negative territory. This was the period of extremely low interest rates globally. And now we seem to have entered an era where, again, the regime is changing and we seem to be moving back to higher interest rates. Now, that's not to suggest that 5% is the new normal, but I think what I would really recommend and the way we would think about this is that you're not going back to the regime that prevailed between 2011 and 2021, which was the decade of ultra low interest rates with the 10-year bond yield stuck closer to 1.5% than to 3%. So we'll have to see where the new normal is, but it looks like we are in an era of higher for longer, particularly in comparison to the previous decade or more. So this is, the two key highlights that I wanted to share with you from a global perspective. But let's just quickly jump on from here to run through some of the economic trends. Not much to report over here. If you look at this data, I think the key thing that I would point to is that real GDP growth estimates for FY24 still at about slightly above 6%, for FY25 at about 6.3%. This is current Bloomberg consensus estimate for the forward periods. And CPI for FY24 now forecast at 5.4%, which is well within the 4 plus or minus 2% range of the Monetary Policy Committee. And in fact, the latest print, which just came out for October at 4.87%, should give you some relief. The current account deficit has not started to compress as much as we had hoped earlier. Of course, 2023 was a record 2.7% negative, but it looks like in the current year and next year, it will continue to remain just a shade under 2% in terms of the current account deficit, simply because Indian exports, particularly on the goods side, have started to stall. Services exports also not growing as sharply as they were in the previous 2 years. And, as a result of these two, the current account deficit is now sustainably running more at a 1.5 to 2% level. Not a number that we would particularly panic about, but, that's what it is. It's certainly not coming back to the 1% level based on the current interplay of factors we are able to see. The 10-year bond in India currently at about 723. I think in terms of the premium to the US 10-year bond, the premium is more towards the lower side, and that's largely a function of the far more stable macroeconomic environment that you can see some of the parameters on this slide. If we just jump forward to the next slide, this is a lot of high frequency data, so nothing really to highlight over here. Just to sort of suggest that I think now credit growth is getting slightly more normalized at about 13-14% kind of trend line, and that's something that gives us comfort in terms of the underlying growth momentum of the economy. We can just quickly move on to the next slides, where we now talk about trends in earnings and trends in valuation. So that's a further 2 slides down, Niranjan. We can just move to, so here we are in terms of the earnings picture. Now, remember the period March 20 to March 23. In fact, we can take the entire 3-year period together. And this 3-year period has seen remarkable growth in earnings, all the way up from 489 in March 2020 to 835 in March 23. So nominal earnings for the Nifty expanding by over 60% during this 3-year period, which is quite phenomenal, considering that nominal GDP is up only very marginally during this period. And this boom in corporate profitability has addressed the twin balance sheet issues that we faced in India. Both the balance sheets of banks and the balance sheets of the corporate sector today are in much better shape. Forward earnings growth for March 24 expected at 17%. And if you see the next slide, what you'll see is that for the first time over the last 2 months, we've actually seen a little bit of a cut in the estimates for earnings. If you look at that middle section, these are the earnings estimates for March 24, and from March 23 to November 23, now there is about a 1.5% cut in earnings coming through. This is the first time we are seeing earnings getting cut. Otherwise, all the way till September, earnings had actually more or less stayed unchanged. Similarly, even for FY25, we're now seeing about a 3% cut in earnings estimates for FY25, which have come through on the right-hand side. So there is some cuts coming through on earnings. This is something we had talked about earlier as well, that the bar for earnings growth is actually quite high, and we would expect to see some sort of cutback in it as companies report earnings, and that's exactly what seems to have happened. Moving forward from here to look at valuations. Again, regular followers of our webinar are very familiar with this slide. On the left-hand side is the Nifty 50 trailing P. On the right side is the Nifty 50 forward P. The yellow line is the long-term average. The red line is 1 standard deviation above. The green line is 1 standard deviation below. So if you're in that orange territory, you're expensive. If you're in the green territory, you're cheap. But if you're in the white territory, you're somewhere in fair value. And that is really the situation we find ourselves in today. And this is one of the reasons why, if you look at the asset allocation model that we run in our balanced advantage fund, which can go between 30% equity and 90% equity, it's currently exactly at the midway point at 60%, indicating valuations for the large cap being somewhere in the comfort zone, not cheap, not expensive either. On the next slide, you can also see the price to book ratio, again showing a roughly similar picture. It's somewhere in that white zone above the yellow line, which is the long-term average, but in the white zone, and therefore, in that fairly valued territory. Remember, over the last 2 years, if I were to take the highs of September 21 and the current Nifty level of today, the index has moved up, the Nifty at least, at a CAGR of just about 2% per annum over the last 2 years. And this is despite the fact that earnings have gone up quite dramatically. But what this has done is that it has pulled the valuations down from being expensive into far more reasonable territory today. However, this is not the case with the mid caps and small caps, which you can see on the next slide. So if you see this slide, this has got the valuations of the mid cap and the small cap. This is only on the trailing price to book. And the two things that I would highlight is that price to book on the mid cap and the small cap is now actually higher than it is on the large caps, which itself is unusual. Is it warranted or not is a debate for a different day, but it suggests a high level of positivity in mid caps and small caps. It suggests that the bar over which these companies have to jump is already quite high. A lot of the forward growth expectations is now embedded in the valuations, and to our mind, therefore, the margin of safety is now significantly compromised in mid caps and small caps, whereas in the large caps, there is still a fair degree of comfort available on a relative basis, and we'll talk about why this is therefore our preference later on. But this is what the valuation indicates. Here on this slide, we have a comparison, which is also one of the valuation indicators that goes into our asset allocation model, which powers our balanced advantage fund as well as our multi-asset allocation strategy. And both these strategies have a neutralish approach towards equities driven by valuations, and also valuations of equities relative to bonds. How do we compare valuations of equities relative to bond? We look at the inverse of the Nifty P multiple, which is the earnings yield of the Nifty, and we compare that to the bond yield of the Nifty, not of the Nifty, but of the 10-year GSEC, which is currently about 725, 730, and we look at what is the historical gap between these two. The historical gap is that equities tend to trade at a premium. It's about 100 basis point differential. Today, the gap is closer to about 1.8%, which suggests that the on balance is actually slightly more favorable towards bonds. And again, that's a reason why in the range of 30 to 90, our equity allocation is only 60, despite equities, sort of being relatively comfortable compared to their own history relative to their bonds. I would submit that they're still looking slightly expensive. The orange line that you see in the middle, which divides the green from the orange, that's the line at which we would find equities favorable relative to bonds. That's at a gap of -1%, but today's gap is closer to -1.8%. So this is what the comparison looks like. The next slide once again talks about large caps versus mid caps. We've already talked about that in the context of the P by B multiples. Here we are looking at the P multiple, and what you can see over here now is that the Nifty 50 is at a premium of -20% to mid caps, which has historically not been a good time to back mid caps, and which is why our valuation comfort at this point of time is more with the large caps than it is with the mid caps, and certainly far more than it is with the small caps. So very quickly, let me jump on from that to my final slide. We've made this point before. US economic data remains extremely robust. The last GDP print came at close to 4.4%. Remember, Indian GDP data is only 200 basis points higher than that, which just tells you how robust the US data is. Now, of course, there are differences. We look at year on year, they look at seasonally adjusted, but just a simple idea, those two data points tell you how robust the US economy is. It tells you why at some level a slowdown is actually desirable in the US. Unemployment is at a record low level, and inflation is well above the target of 2%, though yesterday's data was better than expected. But again, you have to remember that at 3.3, 3.5%, inflation by their standards is way above the target of 2%. And their inflation data, again, they don't look at year to year, it's a seasonally adjusted number, but their inflation is now back below the Indian data point of 4.78%, 87%, which is the number that we reported for October. Our inflation target, of course, is 4 plus or minus 2, but increasingly the governor talks about 4%. The US, Jay Powell, chairman of the US Federal Reserve, talks about the need to get inflation back to the target of 2%. And, he says that's really what is driving US policy and not just the trend line of where the current inflation data is. So, that would put US inflation target 200 basis points lower than what our central bank governor is currently indicating. And, that's the sort of interplay we would expect to see between the two markets in terms of currencies and bonds. I think what is really complicating the issue, particularly in the US, is that unlike India, where we did see a surge in the fiscal deficit in the year of the pandemic when we did not get tax revenues, we have been on a declining trajectory. If you remember the slide on economics, from that almost 10% fiscal deficit, every year we are trying to now bring it down. The target is 5.9% this year, and eventually the target is to get it down to 4.5% by FY26. This is very different from the US, where the deficit appears to be straight lining at about 7% of GDP over the next few years. And secondly, because the US Federal Reserve is having to engage in quantitative tightening, which means it is having to reduce its balance sheet and sell bonds, it's creating an unfavorable supply dynamic, which therefore means automatically it supports higher US long term yields. And that's the reason why the gap between the two long term yields is much lower than what we have historically seen, perhaps over the last decade, between the Indian 10-year bond and the US 10-year bond. Nifty 50 consensus earnings earlier estimated to grow at about 19% in September year on year in FY24, now estimated at closer to 17%, a cut of about 1.5% over the last 2 months. As I said earlier, we have a much better comfort with large caps as compared to mid caps and small caps. Where does that come from? It doesn't come from what's done best. Now, without doubt, from the start of this year, mid caps have done far better than the large caps, so have small caps, even over a 2-year basis. While the Nifty 50 is sort of flat, total return of maybe 2.5% a year over the last 2 years, the Nifty mid cap and small cap are up in low teens over the last 2 years. But all this has done, in our opinion, is made the Nifty mid cap 150 and small cap 250 rich. That's indicative of the kind of valuation outcomes we are seeing in those territories. And therefore, from a asset allocation framework in which we would tend to emphasize, where the valuations are attractive rather than what has the best momentum, we think the better opportunity lies in large caps as compared to mid caps and small caps. Having said that, we think the best way to go about it is through a staggered approach. You're in the fair value zone, you're not in the cheap zone, and therefore that's why the staggered approach is preferred. Within that, we think strategies like balanced advantage, the multi-asset allocation strategy, and the equity savings funds are favorable because in these three strategies, the fund managers refer to valuations when determining the asset allocation, and therefore these funds are favorable for those looking to make lump sum investments, because if the market were to correct and valuations become cheaper, either through a time correction or a price correction, the fund manager in any case would increase the allocation to equities, and you as an investor would stand to benefit from that. So for those who are looking for lump sum investment opportunities, the balanced advantage, multi-asset and equity savings should be sort of the preferred strategies to consider. So I'm going to halt my sort of opening comments, summing up the broad macro and the earnings and valuation picture in India. So I'll halt at this time and request my colleague Srivatsa, who's been with the firm for over 20 years now. He's both a chartered accountant and an MBA. He manages several funds for UTI, key among them being the UTI Large and Mid Cap Fund, the UTI Aggressive Hybrid Equity Fund, the UTI Equity Savings Fund, and he also manages the UTI Retirement Scheme. But all of these funds that he manages tend to have a large and mid cap orientation, and his investment style is driven by relative value. It's a very disciplined approach towards investing, and particularly disciplined in terms of the way it thinks about valuations. But I'll hand over to him, and he will give you an update and explain his investment strategy in more detail. Over to you, Srivatsa.
Yeah, thank you, Vetri. Good afternoon, everybody. Now, I think just an update on the score. So we have continued the momentum in the last half an hour, and we are at 222 for 1. So hopefully this should be another good day for India, and they should continue the momentum. Now, coming back to the presentation, as Vetri said, the UTI Large and Mid Cap Fund is a fund under the large and mid cap category, where we need to invest at least 35% in large cap and 35% in mid cap. Of weightages are more or less aligned to around 50% in large cap, around 40% and 10% in small cap. These are the broad weightages that we work with. Depending on the movement and also the attrition which happens, it may vary by 2% plus or minus across the three categories. Now, coming to the core tenets of the fund, obviously, when we are having a value philosophy, I think valuation is the first point. Here, typically, we tend to look at good quality companies trading at below historical averages. Generally, if you look at a life cycle of a company, a large cap company or a good quality company, they tend to trade at different valuation parameters depending upon the business environment as well as the management. And markets sometimes have a very short term orientation and give opportunities to longer term players like us to get into those companies at reasonable valuations. That is what we are looking at. And when we talk of relative value, we also look at valuation vis-a-vis the longer term history of at least 5 to 7 years, and also vis-a-vis the market, especially for a very good quality oriented sector like say an IT or a healthcare. Sorry. We also look at what are the valuations vis-a-vis the market. The second is, while we focus on valuations, but there is also an equal focus on quality. So what we want to ensure is that we identify companies where the ROC is greater than cost of capital. Now, in this case, we are willing to give the benefit of doubt to the company if they have not had that past track record. But if we have a very high conviction that in the next 2 3 years the company would generate sufficient ROCE higher than the cost of capital, then we back the company. So there is a good amount of quality orientation that goes into the strategy along with the valuation for the stock filtration. And lastly is a hygiene factor where we typically look at sound businesses both in terms of being fundamentally resilient, and more importantly is a corporate governance where typically from a fund house we only look at those companies in the universe where there is a certain level of governance level that we are comfortable with. So to sum it up, we look at a very disciplined approach that aims to benefit from the fluctuations in the valuation cycle of stocks. As I said, a stock goes through a various valuations over a period of time. Sometimes it can go at 1 plus standard deviation, sometimes at 1 minus. We typically tend to look at the reasons and see that if it is not justified, if the market is giving too much weightage to shorter term factors, then that becomes a pretty attractive entry point for us. Next one. Now, in a value strategy, I think it's very critical for us to have what is the filters that we have, what is it that we will not buy. The first and foremost is any company with poor operating cash flow or weak ROCE through a cycle. So in the strategy, I'm willing to buy a company which has a current weak ROCE based on, say, a last couple of years. But I would typically look at companies which are able to generate a higher ROCE through a cycle, and that is the first parameter that we would be looking at. So any company not meeting this criteria would not be part of this portfolio. The governance part I talked on the previous slide, I think this is more on a firm-wide basis. So any companies with any kind of suspect track record in corporate governance is not included in our coverage. And typically, we tend to avoid or reduce our exposure to companies with debt servicing challenges. I think because given the challenges involved in a high debt and the high risk which is involved, that is something we tend to avoid. The fourth one is mature businesses at expensive valuation. So I think the fund has maintained a strong discipline of not investing in kind of businesses or in companies where valuations are far excessive. And throughout the cycle, we have maintained that discipline, and we would expect to continue with that. And lastly, companies that experience a significant decline in terminal value. So wherever we feel that, like say, for example, an oil lubricant company or a print company or a battery company, where we are not sure what is the terminal value. I mean, the company could last for 10 years or a model could last for 10 years. We typically tend to avoid that company also in the portfolio. So these are the 5 exclusion filters that we apply when we construct a portfolio from this overall strategy point of view. Now, coming to investment strategy, the first part I talked about is relative valuation versus history. So typically for large caps, this is a preferred metric that I would use, and quality also gets added to it. So I look at both parts, but obviously a slightly higher value weightage goes to the valuation part of it. And wherever valuation is favorable vis-a-vis longer term history, we kind of, tend to favor those stocks or companies. Now, coming to mid cap and small cap, since almost 45-50% of the portfolio is invested in mid and small cap, Here, I think our focus is also to look at growth opportunities. The reason being that because, especially on the small cap part, some of the small cap is not very well covered by the market. We believe that there are opportunities, there could be growth opportunities which are available in reasonable valuations, unlike, say, in the large cap or even at the top end of the mid cap portfolio or mid cap index, where it's difficult to find growth oriented stocks at reasonable valuation. So, this is again a preferred metric. And thanks to a very strong in house research, we are able to identify a lot of these companies which have proved to be winners for us in the last 3 to 4 years. And mean reversion is essentially, I think, we apply to a lot of cyclical companies as well as leaders who are struggling where the cycle is adverse. So typically what we tend to look at is that we typically tend to look at the business cycle and convince ourselves that the business cycle is at the bottom, or at least in the start of an upcycle, and the valuations are favorable. Generally, here the valuation metric also we look at is more in terms of price to book or what is the replacement cost, because valuation based metrics would typically tend to mislead in these kind of sectors. So this is more of cyclical sectors, whether it is CVs or whether it is cement or whether it is metal, which is at the farthest spectrum of the cyclical sectors. So these are the three broad strategies that we apply when we construct the portfolio. Now, coming to the sector-wise valuation, so in terms of overweight sectors, I think what you would see is that the P of the sectors where we are overweight is kind of significantly lower than the P of the sectors P as well as the price to book, where we are kind of underweight. And even if you look at within that particular sector, like for example, even if you look at the underweight sector, whether it is consumer durables or whether it is FMCG, whether it is chemicals, whether it is construction material, whether it is IT, I think the P multiple or the price to book is at a significant discount to the index or whatever is present in the index of that particular like in terms of the index constituents. So this shows that we have maintained a very strong valuation discipline when it comes to constructing a portfolio. And the top end, if you look at the top 6 sectors where we are overweight, and as I said, if you compare the valuation metrics, again, it is significantly lower than the bottom 5, 6. And even here, I think our focus is to again find relatively cheaper stocks within this sectors where we are underweight. And if you look at some of them, like for example, auto and auto components, which has been a significant active weight for us, the focus is more on the value part of the auto and auto components. Similarly, goes with healthcare as well, where again it's a significant overweight for us. So we are kind of looking at more at the value part of those sectors. So all in all, to sum it up, I mean, if I look at the sector allocation, I think we are generally overweight in sectors which are more value within from an index perspective. And even within those sectors, we typically tend to focus on stocks which are more value, thus giving it a very good value orientation. And consistently, we have kind of maintained this discipline over the last 4 to 5 years. Now, just to elucidate what I've been saying, so we have also been, very kind of proactive to, to kind of invest in times where certain sectors goes through some valuation mismatches. So if you look at the information technology, so if you look at the PE ratio of the Nifty IT index, so whenever the PE ratio has been kind of down, or weightages or active weights have been kind of higher. And at the same time, if you look at the orange line, whenever the P ratios have expanded, for example, in the early 22, when it expanded very sharply, we moved up to a very sharp underweight at that point of time, taking cognizance of the valuation. Similarly, in terms of metals, as I said, cyclical sectors, it makes sense to look at only price to book. Wherever the price to book has been kind of down, our overweights have been higher. And in the last couple of months, where the sector went through some kind of a correction in price to book, we have further kind of, made it an overweight from an underweight. So these two examples broadly, bring about the point that we have been very kind of alert, and we have been very alert and constructive in taking exposures whenever I think there has been a kind of a drawdown in the valuations of the sectors, and at the same time, when the sector is rallied and looks expensive from an earnings perspective, we have also not shied away from booking profits and moving to other sectors where valuations are more reasonable. Third example, I think capital goods, we were kind of overweight on it when the valuations were reasonable because we were kind of seeing very sharp recoveries there. But the moment the valuations went out of range, we have completely exited. I mean, we just have 50, 60 bips exposure in the capital goods. But at one point, we were overweight by almost 200 bips a couple of years back. But over the last 1.5 years, we have almost exited the sector, given the kind of steep valuation the sector trades at. Again, reinforcing the discipline that we bring into the process. Now, coming to the small cap, I think since we have almost 8-9% of our exposure in small caps, I think what I want to bring about the point is, one is that it is spread over more than 11-12 stocks. So generally, the weightages are capped at around 1%. And broadly, we start with 50, 60 bips. And then depending on the comfort level, we gradually increase it to 1%. But the average weightage of the stocks would be closer to 60, 70 bips. The second thing is allocation to high quality companies there, because when it comes to small cap, our focus is on high quality. So over a period of time, we have ensured a discipline that whatever company comes into the portfolio is typically a kind of a high quality company with low debt and having a reasonable amount of consistency. And this is brought about the fact that as on September 23, we have close to 90% of our company in what we call the R1, where consistently they've been able to generate ROE of greater than 18%. And also the small cap allocation has consistently been in the region of 8 to 12, 13%. One thing you also need to remember for this strategy, there is a fair amount of movement which happens from mid to small cap, small to mid. So I would say almost 50, 60% of the small cap exposures would typically qualify as a mid cap. I mean, if there is a sharp outperformance in a season, definitely, they are in the borderline. So the real small cap would probably be half of it, 4, 5% of the portfolio, which is in the market cap of say, 4 to 6,000 crores. So to that extent, the risk is far, far more lower. Our exposures has been high in sometimes, largely on account of the fact that the attrition happens from large, mid to small, and we take some time to balance it and get it below 10. But our endeavor is to maintain around 10% weightages in the small cap, and they've been a pretty good source of alpha for us in the last 3 to 4 years. So we have played around with small cap rally, but again, our focus is again on valuation here. So we don't pay a high price for the growth that we get into. And B, in terms of weightages, in terms of risk, we kind of monitor it very closely, and we typically don't go more than 1% active weight on any small cap stock. Yeah, next one. Again, the other part of our portfolio in terms of how we have run the strategy is also to look at turnaround candidates, because they can be a good source of value. Here again, we look at quality companies which are going through a very bad patch, or which had issues in the past. There has been the change in the management. So in both these cases, I think there has been a kind of a change in the management and articulation of of a new strategy, which has kind of played out. And the moment the market started seeing the fruits of that strategy change in the strategy, both these stocks have kind of significantly outperformed the index. So our endeavors to look at companies like this, which are, a reasonably good quality company led by good promoters, but going through challenges. And the most important part is that we are seeing some articulation of what is the improvement going forward. So this is again a very good source of alpha for us. Wherever kind of, we have taken exposures in these companies, we kind of filter those conditions and then take an exposure. And generally, I think our hit rate has been pretty high in this category. Next one. Now, coming to where we have an active weight on. So in terms of a key active weights, I would say are auto and auto components, financial services, construction, healthcare, and reality. Now, one common thing about these five, maybe to a certain extent, healthcare, is that they are all focused on domestic growth. So, as a overall macro theme, we are quite positive on the domestic recovery, domestic growth. Auto and auto components, I think we are yet to see the full benefit of the recovery. I mean, some segments as two wheelers, we are still below the pre-COVID level. So we would kind of see a very sharp. We should see some kind of a recovery happening in that sector, and valuations are still quite reasonable, and more important, are very reasonable for the set of companies that we have chosen to invest in. The second thing, going with financial services, I think they have kind of, especially the banks, the large cap banks have kind of delivered very good outcomes in the last 5-6 quarters, and the market has not rewarded them commensurately. So we still back by the large cap banks here, and that forms the bulk of our portfolio. We have also taken constructive exposures in NBFCs, insurance, and AMC. So it's a very well diversified, but broadly, we remain very positive on the financial services. Again, a play on the domestic growth recovery and a reasonable valuation. Healthcare is, I think, a combination of both. We have both export oriented or generic companies, because we saw that there was a revival in the US generics, and to that extent, we have played on 3-4 companies benefiting from that, as well as the fact that the domestic recovery was also quite strong. So we have played with that as well, and we also have a hospital company which has done pretty well for us. Uh, Now, and lastly, reality. I think this has been an overweight sector for us for the last 2-3 years. The key theme here is that we are seeing a fundamental change in the sector in terms of consolidation and strong growth happening, and we also see the cycle lasting for another 3-4 years. So we are still comfortable with our overweight. The other one where we have taken a valuation based call is metal and mining and oil and gas. I think both these, we have moved from a negative active weight to a positive active weight in the last 1 year. Now, both these, I think, again, as we are playing through a cycle, the valuations have corrected, and we also believe that the prices are quite favorable. The end prices are quite favorable, and we have taken an active weights on both these sectors. Purely, it's a valuation call within that cycle that I kind of maintain. Now, sectors where we are underweight, I think, in terms of valuation, I think still consumer durable and services, the valuation remains pretty high. And these are the sectors, where we are underweight. Though I think we remain quite positive on the growth prospects, but this is something that we are underweight. And capital goods is something where we are underweight by a wide margin, because the sector valuations are extremely high, and we don't find any stocks bearing one or two which kind of justify this kind of a strategy. So we have taken a call to go underweight on the sector. And lastly, the power side, we were kind of very positive on power 2-3 years back, but again, given the very steep rise in the valuations, we have almost exited the power positions that we have in the last 3 to 4 months. So again, this clearly shows our commitment to follow value, and wherever I think there is a good scope of both reasonable growth and valuations, we have not shied away from taking an aggressive bet. And wherever valuations are not in our comfort zone, we have also taken the risk, or I would say we have stayed true to our style by not investing in the sector, because the valuations are clearly way above our comfort level. Yeah. Next one. Again, the top holdings, a blend of, if you look at the left side, it's a blend of both large and mid caps, and there is a reasonable amount of mid caps as well in the top 20, which has a decent amount of active weight, because that's how we kind of create alpha. And if you look at the right hand side, it's mostly small caps, which are unique stocks. And as I said, if you look at the kind of the list of that, most of them are reasonably good quality companies, and trading at reasonable valuations. Yeah, next one. So I think that brings me to the end of the kind of presentation, and I'll just hand the floor back to Niranjan.
Sure. Thanks a lot, Srivatsa, for that rundown on the fund, UTI Large and Mid Cap Fund, following relative value strategy. So just an update to our viewers on the score. So India is at 267 with 36.2 overs completing with 1 wicket down. Kohli is at 87 run, and he is fast approaching 100. So he'll be the first Indian to achieve this. In fact, the cricketer to achieve this milestone. So we wish him the very best for that. Shreyas Iyer has just completed his off century as well. So back to our discussion, viewers. Thanks for your questions and kindly keep posting your questions. So we will take as many questions as possible in the next 15 minutes or so. So here's the first question to you, Srivatsa. So this is coming from our viewers. So you alluded that you are significantly underweight in capital goods. So all the way from overweight position today, it is just about 50 basis points. So you said valuation is the main reason for you to take that call. So in addition to the valuation, so do you see any other red flags in the sector or the businesses? So where which has made you to take that significant underweight call? If you can elaborate that.
See, I think I'll just focus on the valuation part, because if I look at the businesses, they are pretty strong, and most of the companies in the coverage or rather in the index are pretty very strong, who have gone through a life cycle. So I don't have issues on the business part. But yes, today, if I look at the valuation, the average valuations are more than 45, 50 times 1 year forward. And I'm also not sure whether the growth justifies those valuations. See, when they were at 20, 25 times or 15 to 25 times when we took an exposure, at that time, there were clear signs of growth which was visible. Even now, growth is visible, but I'm really not 100% sure whether the growth will match to that extent that the valuation is asking for. So there is an asking rate for any kind of growth, and I don't think it matches that. So it's largely a valuation call that, we have shied away from taking exposure in that sector.
Sure, thanks a lot. Fair enough. Vetri, there is a question to you. So the rising US bond yields and the concerns about the potential rate hikes seem to have actually dampened the investor sentiments, right? So what is your view on the concerns about the global economic and also the financial fragmentation, which is actually intensifying over the recent years, particularly in the 2 to 3 years, amid the rising geopolitical tension? So if you can throw some light there.
Yeah, thanks, Niranjan. So let's just take the first part, which is about the interest rates, and then we can talk about fragmentation. As we talked about earlier, I think that unusual period of slightly more than a decade, when we got accustomed to negative interest rates, when we got accustomed to the US Federal Reserve barely able to lift its policy rate away from the zero bound. I think that period is now behind us for a variety of reasons, including the fact that today the source of inflation appears to be supply-led. The source of inflation appears to also be led by fiscal excesses. And in this, I'm particularly referring to the developed world. So given this environment, which seems to be characterized more by supply shocks and fiscal deficits, you have to worry that rates have now moved to a new orbit, not an unusual orbit. To be very fair, if you go back 20 years or 30 years, this was the kind of orbit that we would have expected from interest rates. And I think the thing to remember is that these rates are now here for longer, which is to say that the new equilibrium, which may not be at today's rate, the rates could well come off slightly from the current peaks, but more likely that we will experience a plateau of consistently higher rates as compared to the previous decade. And I think that is what we must prepare ourselves for. In that kind of an environment, debt becomes a very acceptable asset class in the portfolio of long-term investors, be they retirement funds, pension funds, so on and so forth. And you're already seeing signs of this. The inflow into money market funds in global and US money market funds in the current year is most likely running at a run rate. This is based on Bank of America data. In the current year, it will most probably grow by almost $1.5 trillion. This is the current run rate. We'll have to see how the flows for November and December behave. But remember, when $1.5 trillion of money then flows into money markets, obviously that money is either not flowing into risk assets or it is flowing out of risk assets. I think the asset classes most impacted by this return to normalcy in interest rates are asset classes which are more illiquid in nature. This could be private equity, it could be venture capital, it could be commercial real estate, it could be be structured credit. These are areas of the market which are already seeing stresses. But eventually, even equities, which have benefited from this low cost of debt for more than a decade, will also feel a little bit of the pressure as long-term capital allocators readjust their allocation towards fixed income, giving the contribution that it can now make to their total return as compared to what they were getting over the previous decade. So I think this is the structural regime that we have to prepare ourselves for, that debt once again becomes a magnet for capital allocators because it's yielding a reasonable return to investors looking for yield. The hunt for yield has come to an end. As far as the second part of your question is concerned, which is more to do with fragmentation, this is partly also creating, to some extent, the supply pressures which are moving inflation numbers higher, because for almost 2 decades or maybe even 3 decades, the world has been operating on the principle of lowest cost of production and globalization. Let production happen at wherever is the lowest cost and let it flow to the areas which then consume these low cost production. Today, suddenly, national security, control over supply lines, the desire to have sovereign control over supply chains has become a lot more paramount as foreign relations have tended to fracture. And those fractured foreign relations are leading to a fracturing of global supply chains and eventually also of global capital flows. So these two also will have their own impact in terms of restructuring both capital flows as well as production bases. I think as far as India is concerned, the latter may actually provide a little bit of an opportunity, because remember, Niranjan, we were never as dominant in global supply chains of manufacturing as, let's say, certain other countries like China were. And therefore, this becomes an opportunity for us to benefit from a little bit of rebalancing. And also, India appears to be in a little bit of a global sweet spot from a geopolitical standpoint. So I think the latter might actually contribute a little bit of an opportunity to India. But the first point, which is that about higher for longer, less risk capital to go around, I think that becomes a challenge for all countries, including India, because in India, while we have a healthy domestic savings pool, remember that in order to grow, you need to invest, and India would typically like to invest more than she domestically saves. And under that scenario, you want to attract capital from the rest of the world, but when that cost of capital moves higher, then it creates challenges in terms of attracting that capital. So I'd still say we are relatively better placed, but these are the challenges that we will have to deal with.
Sure. Thanks a lot, Vetri. Great insights. Moving back to the discussion on the fund, UTI Large and Mid Cap Fund. So, as the fund mandate says, we should invest minimum 35% each in large cap and mid cap, right? So, however, the cumulative holding of the fund in the mid and small cap accounts to 48%, right? So, given that the current the valuations are slightly elevated in these two pockets. So, what is your view in terms of the allocation that we have here?
So if you look at the valuation part, I think while the index valuation is kind of suggesting that the valuations are high, but one should keep in mind that in both mid cap, of course, to a large extent, and small cap, the universe is pretty big. So you may have the top 20 stocks, say, trading at price to book of 10 times or PE of 40 times, but there would also be a sufficient universe which would trade at reasonable valuation. So our focus is to find stocks in both these categories, which kind of fit into our valuation parameters or into our strategy parameters. And we have been able to find that consistently. So we have had this allocation consistently in the last 3-4 years. And as I said, the additional measure that we are also doing is that, especially on the small cap, which is a riskier part, we are spreading our allocations to more than 10-12 stocks. So the average allocation is between, say, 65 to 70 bips for a small cap. But the focus on valuation is there. And, while the index headline numbers may denote a different picture, but I think it's more of a bottoms up there. So any fund manager should be able to find decent ideas in both from a value perspective in both these categories.
Sure, thanks for that. There is a follow-up question again back to you, right? So, given that the also what do you say, follow the value strategy, and what we have seen in the last 2 to 3 years period is that value has outperformed the growth stock significantly, right? So with that backdrop, how do you think one should look at UTI large and mid cap fund, which is following relative value strategy, and how it can actually fit into the one's overall portfolio
Yeah.
from medium to longer period of time?
Sure. I think, see, one should keep in mind when you're talking on those metrics that value has significantly outperformed. So, if I look at the value index, I think that is significantly different from our portfolio. So, possibly our exposure to stocks in that value index would be less than, 10-15%. So, that's a kind of, I would say, a pure value stocks which are trading at cheap multiples. We don't exactly follow that strategy. Of course, there is some element of those strategy in our portfolio, but it is not the dominant part. The dominant part is, I would say, more of stocks which are reasonably good quality ones and trading at reasonable valuation. So I don't see that as a challenge that if tomorrow value were to significantly underperform, this fund would get affected. There would be some limited impact, yes, but not to the extent the maybe the investors or the market, if they are expecting a very sharp mean to reversion in the quality versus value, that may not reflect in the fund. And the other part is also that while we have outperformed the benchmark, which is Nifty large mid, but in the last couple of years we have kind of underperformed the value benchmark, and this has got to do with the fact that our correlation is very less. We just have less than 10-15%. So overall, we believe that while there could be a case that, and of course, I will also not, there could also be a case that the fund may underperform for a brief period of time if the real quality part of the market starts performing, because that is where we have very low exposure. So, to sum it up, I think while we follow value, but we don't follow pure value, which those indices kind of follow, or which the market is kind of suggesting.
Sure. Thanks a lot, Srivastava, for that. Makes really a lot of sense. Vetri, one question to you. So, while the equity markets have fairly rewarded investors in the longer period of time, so on the last 1 year and 2 year basis, the returns have been little sporadic, right? So there have been significant divergence in terms of the returns within a particular category of fund as well. So how do you view this phenomenon currently and also going forward?
Sure, Niranjan. I think there are 2-3 things to keep in mind. That in the first place, returns from equity markets are not linear, which is to say, if you think about a particular long-term return, just for argument's sake, let's say, 11 to 12% per annum is the total return you can expect from Indian stocks based on historical data of the Nifty 50 over a very long period. And if you look at sort of, 5-year, 7-year rolling returns, that's the number you would end up with. But does that mean every year you will earn that 12%? The answer is no. Very often there are years in which it could be massively positive, just as there are years in which it could be strikingly negative. So it's not a normal distribution of returns. There are fat tails at both ends. And this is true not only at a index level as an asset class marker. This is also true of styles. It's also true of large versus mid versus small. So the simple way I would sort of recommend to investors to deal with this, well, theoretically, there are 2 ways to deal with this. You could turn out to be an expert market timer. You exactly know which asset class will do well, when it will do well, which style will do well, exactly when it will do well. The points of inflection are very well known to you, and you are able to catch every change in the tide and in the momentum of those styles or of those market caps. Then hats off to you. That's the strategy you should use to keep rotating. But for most people, I think the simpler solution to use is to acknowledge that these returns are not linear, and therefore the way to tackle this is actually to diversify your portfolio more broadly, diversify it across asset classes, diversify it across different market cap styles, market cap buckets, and also diversify it across different investing styles. And if required, also use certain sectors and themes at different points of time with slightly more, with limited exposure, but slightly more fine-tuned entry and exit strategies to overall create a more diversified portfolio which will reflect broad market trends. So I would say use diversification rather than using the timing methodology. But if you're sharp enough to do the timing perfectly, then, hats off to you.
Thanks a lot, Vetri. So, in the interest of time, we will take last two questions. Maybe, Vatsa, if you can quickly throw up on the, which are the sectors that you are actually looking out to play in the near term and also looking to build in your portfolio. So, 2-3 sectors, if you can just throw some ideas there.
Yeah, as I said, I think auto, healthcare, and financial services is something I'm quite positive about. I think we can still expect a decent amount of growth in these three sectors, and the valuations are still reasonable, especially in financial services. If I talk of banks, we are talking of very reasonable valuation here. And also, I've taken some kind of a valuation based call on the global oriented sectors, such as oil and gas and metals. I've gone active it. And I'm also keeping a watch on consumer durables as well as consumer services. I have limited exposures there. But given the prolonged underperformance, if something comes within the relative value in both these sectors, I would be happy to look at them. But yes, that's where, I'm kind of looking at it because these are decent index weights which have underperformed. And there could be a point of time where valuations could be more appealing from a relative point of view. So these are the broad, sectors that I would be looking at in the coming quarters.
Sure. So thanks a lot. One final question to you, Vetri, and in fact, you can conclude the webinar after this. So typically the investors are actually little nervous about the stock market scaling new heights as we see that markets hitting new heights at the regular intervals, right? So what is your piece of advice to the investors who actually feel a little nervous about this? And even some of the investors who invested for a very long period, they also feel this happening. So how do you view this situation and your world of thoughts for them?
Sure, Niranjan. I think first of all, particularly when I look at the Nifty, the picture does not look so worrying. As I said, over the last 2 years, the market has not covered much ground. So it doesn't look like one of those particularly scary points. But that's, not saying much. I think the broad sort of thought process investors need to have in mind is that equity markets are volatile. They are volatile for a reason because even more than their long-term trajectory being inclined with the rate of earnings growth that the underlying companies are able to generate, there is a much bigger fluctuation which happens around those values simply because the market is also driven by cycles of emotion which reflect either extremes of greed and at sometimes they reflect extremes of fear. And that is why when you look at stock prices, they are far more volatile than underlying volatility of corporate earnings, which in turn are far more volatile than the underlying growth in GDP. So these are the two important things to keep in mind. And therefore, any investment approach that you have needs to have certain elements built into it. One of them is related to how you invest more systematically, perhaps. Another, which we don't talk about enough, is how do you take money off the table, which is perhaps more and more something that people will want to look at systematic withdrawals as an option to do that. But finally, you also need to have some method by which you will rebalance your portfolio at some sort of appropriate levels. To my mind, this systematic investing, systematic withdrawals, combined with periodic disciplined rebalancing of portfolios is the way to really navigate markets. You will never know beforehand what causes markets to sell off very sharply, just as, believe me, it is sometimes very difficult to fathom what are the reasons which can cause a market to rally very sharply. Both are equally difficult to call out in advance. The biggest risks to the upside and the downside are rarely visible in advance. It's an unknown surprise when it actually happens. So the way to deal with this is to have that valuation framework of systematic investing combined with a asset allocation framework, and that's how you can deal with it. Remember, investing outcomes eventually have more to do with your own behavior than they have to do with the actual performance of the companies that you are invested in. So I think that's a useful distinction to remember. But, I'll halt today's session over here. I'm keenly aware that many of you are now looking forward to get back to the cricket match, where it at least seems the score at 40 overs is still going brilliantly with just one wicket down at 287. So, that's a great sort of outcome and trend line for India at this point of time. So, I'll, without any further ado, call a close to today's session. Of course, do join us in December for what will be the last edition of the Equity Market Insight for calendar 2023. But happy viewing and all the best to Team India and the men in blue.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.